Alright, so let's continue with the preparation and interpretation of ratio analysis. Okay, so we are going to use an example. Okay, alright, so let's read together. The following information had been extracted from the financial statements of Shiha Trading during the year ended 30th June 2016. Okay, so we have here total sales, cash sales, net purchases, net profit, inventory at the beginning of the year, inventory at the end of the year, bank, accounts receivable, non-current asset, current liabilities, and owner's equity. Okay, so if you see here, these items are only extracted from statement of profit or loss and statement of financial position. Okay, they did not provide you with a proper statements. All right, so meaning you have to when we need to use the information, okay, if the information is not there, then you have to recall on the preparation of the financial statements, all right, on how to calculate certain item. All right, okay, so let's look at the requirement. So you are required to calculate the following ratios. Number one, the current ratio, asset test ratio, gross profit margin, net profit margin, inventory turnover ratio, and the average collection period. And we need to assume that there are 365 days in a year. Okay, and then to briefly explain the ratio calculated above. Okay, all right, so let's start with the first one. Okay, so the first one is the current ratio. So what is the formula for the current ratio? Current asset divided by current liabilities. Okay, so now let's look at the question again. Do we have an item of current asset? We don't have any current asset here. Instead, we have non-current asset. Okay, but we do have the items of non-current asset, which are the closing inventory, bank, and accounts receivable. So we need to prepare a working, okay, to calculate the current asset. Okay, for example here, so current asset is equal to the closing inventory plus bank plus account receivable, and the total is 50,300. Okay, what about current liabilities? Do we have any current liabilities here? Yes, current liabilities is equal to 17,000. Alright, so we can now calculate the current ratio. So 50,300 divided by 17,000 is equal to 2.96. Okay, so when we show the result, we show as 2.96 to 1. Alright, if you still remember from our previous discussion, 1 is represent the current liabilities, while 2.96 represent the current asset. Okay, what about the asset test ratio? So asset test ratio, we need to remove inventory and prepayments from the computation. Okay, so the total current asset is 50,300, and then we are going to deduct, okay, we don't have prepayment here, but we do have the closing inventory. So we're going to minus closing inventory of 20,000. Okay, so 50,300 minus 20,000 divided by current liabilities of 17,000, and the answer is 1.78 to 1. Okay, again, so 1 represent the current liabilities, 1.78 represent the liquid asset of current asset, because we remove the least liquid asset, okay, which are inventory and prepayments. All right, okay, next. Okay, next we are required to calculate the gross profit margin and net profit margin. So these two are the profitability ratio. So how to calculate the gross profit margin? It's very simple. Gross profit divided by sales. Okay, for net profit margin, net profit divided by sales. Okay, so we're going to refer, okay, to the question. Okay, for any gross profit and net profit, do we have any gross profit? No, we don't. But we have net profit. So we don't have any problem identifying the net profit. Okay, we do have the net profit, but we need to calculate for gross profit. Okay, so I hope you remember how do we calculate gross profit in the statement of profit or loss. We have sales, okay, and then we minus cost of sales. What do we have inside cost of sale? We have opening inventory plus purchases minus closing inventory. Alright, so as simple as that. Okay, we do have total sale, we do have purchase, opening inventory and closing inventory. So using this information, okay, it is enough to calculate gross profit. Okay, so we're going to start from total sales, 120,000 minus cost of sale. So how do we calculate cost of sales? Opening inventory, 23,000 plus net purchase, 46,900 minus closing inventory, 20,000. Therefore, cost of sale equal to 49,900. And the gross profit is total sales minus cost of sale equal to 70,100. Okay, so let's continue with the computation of gross profit margin. So gross profit 70,100 divided by 120,000 total sales times 100. Okay, because we are going to show the result in percentage. Okay, and the result is 58.42%. And the net profit margin is net profit divided by sales times 100. And net profit is given 38,600 divided by sales 120,000. And the result is 32.17%. Alright. Okay, so let's move to the next one, which is efficiency ratio. Okay, which are inventory turnover ratio and also average collection period. Okay, so for inventory turnover ratio, the formula is cost of sale divided by the average inventory. Okay, so cost of sale as computed before, alright, is equal to 49,900 divided by the average inventory. Average inventory, okay, is the opening plus closing divided by 2. Alright, and the result is 2.32 times. Alright, there is a situation where you might not have opening inventory. So if you don't have the opening inventory, meaning that you don't have to use the average inventory, but you replace that with the closing inventory only. You don't have to divide by 2, because if we use the closing inventory, meaning we are not using the average inventory. Alright, okay. And the next one is the average collection period. So the average collection period, the formula is accounts receivable divided by credit sales times 365 days. Okay, so how much is the credit sales? Okay, so far we are using only the total sales, which is 120,000. But how much is credit sales? Is it given? No. What we have here is only total sales and cash sales. Okay, so using these two, we are going to find, okay, or calculate credit sales. Okay, so total sales minus cash sale equal to credit sales. Okay, all right. So in the situation where you are not, they did not provide you with the amount of cash sales or credit sales. Okay, so we are going to assume that the total sale are credit sales. Okay, the total sales, okay, are credit sales. Okay, all right. Okay, so 20,300 divided by 120,000 minus 41,200, okay, times 365 days, and the answer is 94 days. All right, so we have done with the computation of the ratio. And next is to briefly explain or to comment or to interpret on the results. All right. Okay, so we're going to start from the current ratio. Okay, so the current ratio is 2.96 to 1. It means that the business has RM 2.96 of current asset to pay for every 1 ringgit of its current liabilities. All right. So the business is in a good position. They can cover their debt. All right, what about the asset test ratio? Okay, using only the liquid asset, do we have enough to cover the current liabilities? Yes, the result is 1.78 to 1. Okay, even after you pay for your current liabilities of this 1 ringgit, you still have a balance of 0.78. Okay, another explanation is the business has 1 ringgit 78 cent of current asset to pay for every 1 ringgit of its current liability without selling its inventory. Okay. All right. Next, gross profit margin. What does it mean by 58.42%? It means that the business makes 58 cent of gross profit for every 1 ringgit sales. Okay. Whereas for net profit margin, 32.17% means the business makes 32 cent of net profit for every 1 ringgit sales. Okay. All right. So meaning for every 1 ringgit of your sales, okay, you as the owner, you have a balance of 32 cent. Okay, you are making 32 cent for yourself. All right. Okay. So what about the inventory turnover ratio? The result is 2.32 times. Okay. It means that throughout the year, the business replaces its inventory 2.32 times a year. Okay. Alternatively, the business replaces its inventory every 157 days. Okay, how to calculate this one? 365 days divided by 2.32 times, okay, in a year. Okay, so to replace the inventory only 2 times a year indicates that you have a slow moving stock or you did not make sales fast enough. All right. Okay, so maybe they need to improve this area. Okay, and then the average collection period, 94 days. It means that the business takes 94 days to collect debt from its debtors or receivables or their credit customer. Okay, about 3 months, okay, after the sales took place. Okay, and then they collect the money from the debtors. If you think this is if you think the 94 days is very long, then the business need to do something to improve the situation. Maybe they have to tighten the policy, the credit policy. They have to shorten the credit term. All right. So the business may take the necessary action to improve this efficiency ratio, okay, related to inventory turnover and also the average collection period. All right. Okay. All right. However, okay, for the ratio analysis, there are limitations. Okay, so limitation number 1 is related to the information itself. Okay, so the information that we use is historical information. Okay, based on the past result. Okay, because we use the financial statements. Okay, and the financial statements are the transaction of the whole year. Okay, so it could be past information. Okay, all right. Okay, it does not consider any inflationary effect. Okay, because the financial statements are released periodically and therefore, okay, there are time differences between each release. Okay, from this year to next year. All right, or compared to the previous year. Okay, so the real prices are not reflected in the financial statement. Okay, and then changes in accounting policies. It is common that throughout the years, okay, the authority might change the policy. Even the company also might change the policy. Okay, changes in accounting policy. There might be a changes to the standard. Hence, it will affect the accounting policy of the business. Okay, and this also may significantly affect the financial reporting. Okay, so if we want to make a comparison throughout the years, then we have to take into consideration, okay, we have to take into account, okay, that this result is before the change and this result is after the change, because there might be significant difference to the result. Okay, all right, and then operational changes. Okay, a company may significantly change its operational structure. So when change happen, okay, there might be a misleading conclusion about the company's performance and prospect. Okay, it is the change in the amounts and also the figures in the financial statement could be due to the change in the operational structure. Okay, so that one also we have to be very careful. Okay, we must make sure that we know, okay, when is exactly the change happen. Okay, so that when we make a comparison between a period of before and after, okay, if there is any significant change, okay, which is not good, then we have to analyze carefully. All right, we have to make a careful consideration. We have to really look into the matter. Is it because of the problem with the business, or is it simply because of the change in their operation? Okay, similarly for change in accounting policy. All right, okay, so next, seasonal effects. All right, so an analyst should be aware of any seasonal factors. Okay, for example, there might be a difference between sales at the beginning of the year and sales in the middle of the year. Okay, because it is common that at the beginning of the year, people may not spend too much. Let's focus on like for example, the individual customer. Okay, because they have other commitments at the beginning of the year. But at the end of the year, because of sale, because of the promotions, because of the sales at the end of the year, okay, so they might spend more compared to at the beginning of the year. And maybe we have a holiday, okay, holidays like Hari Raya, Chinese New Year or Christmas, where people spend more than usual. Okay, and then there might be also a possibility of manipulation of financial statement, which will affect the ratio analysis. Okay, so when you analyze the financial ratio, you have to bear in mind of this limitation of ratio analysis, and you make sure that okay, you take into consideration, okay, when there's a significant change happen to the business. Okay, all right, so that's all for topic 7, and thank you.